Resorts World was supposed to be the Strip's next legend, a $4.3 billion marvel of ultra-luxury, technology, and ambition, opening its doors in 2021 with sky-high expectations. But less than 4 years later, its glittering halls have grown emptier. As revenue crashes 22% year-over-year, profit margins evaporate, and occupancy drops for the second quarter in a row. How did the most expensive resort in Las Vegas go from high flyer to cautionary tale almost overnight? To answer that, we have to pull back the velvet curtain and uncover what's really draining Resorts World's promise, and why so many are asking, why is Resorts World Las Vegas so empty? When Resorts World Las Vegas opened its doors in June 2021, it wasn't just another addition to the Strip. It was a declaration. Backed by Genting Berhad and carrying a $4.3 billion price tag, the project stood as the most expensive resort ever built in Las Vegas history. The vision was clear: a modern mega resort that would redefine luxury, technology, and scale for a new era of Vegas travelers. Rising from the ground on the north end of the Strip, the property offered 3 gleaming hotel towers, each with its own branded experience: Hilton, Conrad, and Crockford's, totaling over 3,500 rooms and suites. The amenities list read like a wish book for high rollers and global tourists. There was a 117,000 square foot casino floor, packed with the latest slots and table games, a 5,000-seat theater designed for superstar residencies, and more than 40 bars and restaurants curated by celebrity chefs and renowned culinary teams. Beyond gaming and dining, the resort boasted a sprawling pool complex, high-end retail galleries, a day club and nightclub partnership with Zouk Group from Singapore, and a dedicated spa and wellness center. Every detail, from the digital check-in kiosks to the cashless gaming systems, leaned into the promise of a tech-forward experience, one that would set a new standard for how Vegas could look and feel in the 2020s. Genting's ambition wasn't just about luxury, it was about scale and spectacle. The resort's digital LED facade, stretching 100,000 square feet, became an instant landmark, lighting up the skyline with dynamic art and advertising visible from miles away. The property's opening week drew crowds and headlines, with A-list performances and a sense of optimism that Resorts World would anchor a new wave of development on the North Strip. The bet was bold: invest billions, outshine the competition, and attract the next generation of Vegas visitors, families, international travelers, tech-savvy millennials, and, of course, the global elite. With so much capital committed and so many eyes watching, the stakes couldn't have been higher. The resort's size and cost alone created enormous expectations, not just for Genting and its investors, but for the entire city. In a market that measures success by packed casino floors and sold-out suites, the arrival of Resorts World was supposed to be a turning point, a new benchmark for what Las Vegas could offer. But as the months went by, the realities of operating a mega resort in a changing city would test every part of that $4.3 billion dream. Let's begin with the numbers. In the first quarter of 2025, Resorts World Las Vegas reported revenue of just $166 million. That's a 22% drop compared to the same period the year before, when the property brought in $214 million. The decline didn't stop at the top line. Earnings before interest, taxes, depreciation, and amortization, EBITDA, fell sharply, from $40 million in the first quarter of 2024 to only $10 million in the first quarter of 2025. That's a 75% collapse in profitability in just 12 months, and a clear sign that operating costs are eating away at what little margin remains. This margin squeeze is playing out across every part of the business. In the last quarter of 2024, occupancy slipped to 83.6%, down from 87.7% the year before. The average daily rate, a key measure of pricing power, dropped from $319 to $286. By the second quarter of 2025, occupancy hovered around 80%, well below the nearly 90% level Resorts World enjoyed in its early days. These are not just minor fluctuations. For a mega resort built to fill thousands of rooms and keep casino floors buzzing, losing even a few percentage points of occupancy translates to millions in lost revenue. Industry analysts point to a combination of causes. The initial surge from pent-up post-pandemic demand faded quickly, leaving Resorts World exposed to softer midweek business and a shrinking convention calendar. Competition on the north end of the Strip intensified, with neighboring properties fighting for the same pool of guests. At the same time, broader Las Vegas visitation cooled off, with fewer arrivals by air and less spending per visitor. Genting, the parent company, faces mounting pressure to deliver returns on its $4.3 billion investment. But the property's fixed costs, debt service, payroll, utilities, don't shrink just because fewer guests show up. The impact is visible not only in the financials, but in the daily rhythms of the resort. With lower occupancy, restaurants scale back hours, retail galleries see lighter foot traffic, and entertainment venues struggle to fill seats outside of major event weekends. The casino, once pitched as a hub for high rollers and global tourists, now relies more heavily on promotions and discounted play to bring in business. The result is a cycle of discounting and margin compression, where every dollar earned comes at a higher cost. For Genting, these numbers represent more than a bad quarter. They point to a deeper challenge: how to sustain a property of this scale when the market no longer guarantees full rooms or premium rates. The financial cracks are widening, and the pressure to reverse the slide is growing more urgent with each passing quarter. The reckoning came in March 2025. Nevada's Gaming Commission announced a $10.5 million fine against Resorts World Las Vegas, the second largest penalty in state history. The case centered on anti-money laundering failures, specifically the casino's handling of high-value patrons with criminal backgrounds and its repeated breakdowns in basic compliance. Regulators cited a 31-page complaint detailing how Resorts World allowed millions to flow through its casino without proper source of funds checks. The most glaring example involved Matthew Bowyer, a known illegal bookmaker, who deposited over $2.5 million and played for months without adequate scrutiny. For more than a year, compliance staff flagged red flags, but executives and casino hosts failed to escalate or report suspicious activity. The property extended credit and comped flights to VIPs with ties to illegal gambling rings, while required suspicious activity reports went unfiled. The settlement did more than impose a record fine. Resorts World agreed to sweeping new compliance mandates. The resort must now retain all anti-money laundering training records for 5 years, a significant expansion from standard practice. Compliance staffing is being increased, with new hires dedicated solely to due diligence, source of funds checks, and ongoing monitoring of high-risk guests. The agreement also calls for an independent audit of Resorts World's AML program within 2 years, with periodic progress reports sent directly to regulators. Every host and marketing staff member is now required to undergo retraining, and the property's internal controls face ongoing review by both state officials and outside consultants. Publicly, Genting executives stated the company had invested heavily in compliance infrastructure and was committed to becoming a best-in-class operator. But behind the scenes, the operational burden was immediate. Dozens of staff were diverted from guest-facing roles to compliance duties, slowing down onboarding for new players and increasing wait times for VIP services. The property's reputation took a hit, with media coverage linking Resorts World to high-profile criminal betting scandals and warning of broader industry consequences. In the months following the announcement, VIP bookings dropped, and some high roller accounts moved to competing properties. For a resort already battling falling revenue and weak occupancy, the regulatory shock created a new layer of complexity, forcing leaders to prioritize legal survival over guest experience, and making every operational decision more complicated, more expensive, and more scrutinized than ever before. Guest frustration reached a boiling point long before regulatory headlines dominated the news. In late 2024, what was supposed to be a headline-grabbing partnership, the MrBeast Experience, ended up as a case study in how not to run a major event. Guests arrived expecting the spectacle promised by one of the world's biggest YouTube stars. Instead, they found chaos. Hours-long lines for merchandise, empty food stations, and volunteers struggling to direct the crowds. Complaints flooded social media within hours. By the next morning, requests for refunds were pouring in, with some guests threatening to dispute charges directly with their banks. The event's organizers later admitted that last-minute staffing cuts and poor coordination with the venue left them unprepared for the turnout. Operational headaches didn't stop with special events. Throughout 2024, the property's core guest experience was repeatedly undermined by technology failures and chronic understaffing. A software upgrade to the hotel's property management system, intended to streamline check-in and personalize offers, backfired spectacularly. For 3 hours on a busy summer weekend, every terminal at the front desk froze, leaving hundreds of guests stranded in the lobby. VIPs walked out, families sat on luggage, and frontline staff scrambled to handwrite registration forms. Internal IT logs later blamed the outage on a botched vendor update and a lack of backup protocols. For guests, the only thing more memorable than the LED facade was the wait to get a room key. Dining and service complaints became a running theme on review sites and the Better Business Bureau. Patrons described long waits for restaurant seating, menu items routinely unavailable, and abrupt closures with no warning. Staff interviews point to a simple explanation: ongoing layoffs and budget cuts slashed both headcount and training hours. By late 2024, the average tenure for frontline employees had dropped below 8 months, and training for new hires had been cut nearly in half. The result was a revolving door of inexperienced staff, slow service, and mounting guest dissatisfaction. These operational breakdowns didn't just dent the resort's reputation, they drove away repeat business and group bookings. Convention organizers cited persistent uncertainty as a reason for moving events elsewhere. For a property built on the promise of high-tech convenience and seamless luxury, the reality was lines, glitches, and apologies. The goodwill built during opening week evaporated, replaced by viral posts and refund demands. In the eyes of many guests, Resorts World had become the weakest link on the Strip. Competition on the north end of the Strip has never been fiercer. Resorts World finds itself surrounded by rivals, Encore, Wynn, and the newly opened Fontainebleau, all vying for the same shrinking pool of guests. Each property brings its own established reputation and loyal customer base, making it difficult for a newcomer to draw visitors away. Wynn and Encore, in particular, have spent years perfecting their service and amenities, setting a standard for luxury that's hard to match. Fontainebleau, with its Miami pedigree and fresh marketing push, has added another layer of pressure, capturing attention from both high-end travelers and convention organizers. Market data from the first half of 2025 paints a challenging picture. Strip-wide visitation is down, with fewer tourists arriving midweek and a noticeable drop in group and convention bookings. The Las Vegas Convention Center reported a slowdown in event volume, and major trade shows that once filled thousands of rooms are now booking smaller blocks or moving to other cities. Resorts World, which was built to thrive on high occupancy and steady traffic, is hit hardest when demand softens. Even small dips in citywide visitation translate into empty hotel towers and quiet casino floors. Room rate compression is another mounting issue. As more properties compete for a limited number of guests, average daily rates have slipped across the Strip. Resorts. World's average daily rate fell from $319 to $286 year over year, while occupancy dropped to around 80%. These numbers are not just abstract metrics. They represent real pressure on revenue, with every empty room and discounted rate eating into the bottom line. Meanwhile, established competitors have responded with aggressive loyalty offers, exclusive events, and targeted promotions, making it even more difficult for Resorts World to regain lost ground. Beyond the Strip, broader economic pressures are also at play. National travel trends show a dip in discretionary spending, and Las Vegas is feeling the effects. Visitors are spending less on rooms, dining, and gaming, forcing all operators to fight harder for every dollar. For Resorts World, the combination of intense local competition and a softening market means internal fixes alone won't be enough. The property must find a way to stand out in a crowded, unforgiving environment where even small missteps can have outsized consequences. Genting's response to Resorts World's decline has been swift and methodical. In the wake of regulatory fines and financial setbacks, the company initiated a broad recovery plan, internally branded as Resorts World 2.0. While the specifics of leadership changes remain largely undisclosed, company filings and earnings call transcripts confirm a management transition took place in early 2025, with new executives tasked to restore both compliance and profitability. The first order of business: operational efficiency. Genting's leadership directed teams to scrutinize every expense line, from labor scheduling to supply contracts, looking for opportunities to cut costs without further eroding guest experience. Summer 2025 brought a bold move, waiving both resort and parking fees. This break from industry standard was designed to boost visitation and improve cash flow, especially as competitors clung to their own surcharges. The strategy paid off, at least in the short term. By the end of the second quarter, revenue had climbed to $180 million, an 8% increase over the previous quarter. Adjusted profit, measured by EBITDA, nearly doubled from $10 million in the first quarter to $18 million in the second quarter. While these numbers still lagged far behind the $50 million EBITDA posted a year earlier, the rebound offered a glimmer of hope to investors and staff alike. On the gaming side, Resorts World doubled down on high-end play, investing in targeted marketing for VIPs and restoring some of the perks that had lapsed during the compliance crisis. At the same time, the property expanded compliance staffing and tightened due diligence protocols, as required by the Nevada Gaming Commission settlement. Staff retraining and regular audits became routine, with the resort now retaining all anti-money laundering training records for 5 years. Analysts remain cautious, noting that early progress is fragile and reputational wounds take time to heal. Still, the property's second quarter results suggest that Genting's margin focus and operational reforms are beginning to slow the losses. Whether these moves can restore Resorts World to its original promise, or merely stabilize it at a lower plateau, remains an open question. In the first quarter of 2025, Resorts World Las Vegas reported a 22% drop in revenue and a 75% plunge in EBITDA, despite opening just 4 years earlier as the Strip's $4.3 billion promise of luxury. The resort faced a $10.5 million regulatory fine for anti-money laundering failures, public criticism after the MrBeast Experience event, and ongoing complaints about guest service. Even as leadership changed and a turnaround plan launched, occupancy and average daily rates continued to lag, with the second quarter of 2025 showing only modest improvement. Some internal documents remain undisclosed, and details about future strategy are limited. What's clear is that a state-of-the-art property, by itself, cannot guarantee long-term success in Las Vegas. Resorts. World Story now stands as a warning. In a shifting market, keeping promises to guests and regulators is just as critical as grand openings and glossy amenities.